Hi, this is Dan Tiberio with my Week 8 Capstone presentation on FirstEnergy Solutions, Management of Change. FirstEnergy was created in 1997 as a holding company for the merger between Ohio Edison Company and Centurior Energy. FirstEnergy additionally acquired GPU Incorporated in 2001 and Allegheny Energy in 2011. All of these companies owned three primary areas of business: electricity generation, electricity distribution, and a retail book through which they sell electricity directly to customers. FirstEnergy is a Fortune 200 company with $41 billion in assets and is a top 10 electric utility in the United States. This presentation is going to mostly focus on generation because that is the primary area of revenue generation for the business. Electricity market originally was fully regulated, which means that the electricity generators were allowed to set a price based on how much it cost them to generate electricity. A regulatory authority reviewed that price and the finances of the company and allowed them to set a price slightly higher than what it cost to make electricity to provide a small return on investments for investors, usually like 3%. However, in the late 90s, the competitive market was created in which the cost basis recovery method of pricing was no more, and a market-based system was put into place. Here's how the system worked. A regional transmission operator was granted authority to monopolize the electricity market in a specific region under the oversight of the Federal Energy Regulatory Commission. Electric generators would bid into the capacity market, and they would essentially set the price that they could generate electricity for in the year of bidding. The regional transmission operator would then select all of the companies that were required to generate enough electricity to satisfy the needs of the customers, the consumers of electricity. The highest bidding price within that market would then set the price that was paid to all of the generators inside of that pricing structure. Anybody who was above that price would get no capacity payments as a result. In turn, these companies were required to produce the electricity in that year, or else they were required to purchase it on the spot market, which was usually more expensive. FirstEnergy strongly supported deregulation because it had more significant ownership in coal and nuclear assets than it did in some of the others, and coal and nuclear plants were the most efficient running at the time. However, market conditions have changed over the last 20 years significantly. First, federal and state governments began to support green energy initiatives through tax credits. These green energy initiatives went to companies for building more efficient buildings. They went to companies to build things like solar panels and windmills. They went to consumers for replacing their old appliances with more energy efficient ones. And they also created initiatives to create more energy efficient supplies to the consumers, such as LED light bulbs. This had a significant impact on the amount of electricity demand in the marketplace. The second thing that impacted demand is the recession in 2008 and 2009, which slowed energy consumption as a result of manufacturing reducing as the economy shrunk. Finally, natural gas prices have plummeted in the last 10 to 15 years as hydrofracking has taken hold in certain areas of the country. It's important to note that hydrofracking is very significant here in FirstEnergy's territory in southwestern Pennsylvania, which is also in the PJM territory. Here's the graph from the EIA showing the energy consumption over the last 50 or 60 years. And you can see how in the mid to late 2000s, the energy consumption essentially flatlined and has not risen since then. The electricity mix in the United States is important to note because, as I mentioned, FirstEnergy Solutions are very heavy on coal and nuclear assets. So right now in the United States, there's about 28% of generation that comes from coal, 19% from nuclear, 35% from natural gas, and 17% from renewables. Here's a snapshot of the PJM territory this morning, which is where FirstEnergy Solutions and FirstEnergy operate. So this morning at 7 a.m., 6% of the generation was coming from renewables in PJM, 33% was nuclear, 43% gas, and 18% coal. So you can see that PJM is significantly heavier on nuclear and natural gas, and lower than the national standard in terms of coal generation and renewable. Now, renewable is fluctuating, as is natural gas. They typically fluctuate based on the time of the day as demand rises and falls, and as the sun comes out and as the wind blows and doesn't. So here's a pictorial of that showing you how many plants are needed to generate that kind of electricity. So to generate 28% of our nation's electricity, we need 400 coal plants. We need 1,800 natural gas plants to generate 35% of the nation's electricity. But we only need 61 plants to generate 19% of our electricity from nuclear power. So you can see here that coal plants and nuclear plants are far more efficient than natural gas plants that generate electricity because you can generate a lot more in one site. And this is why coal and nuclear, this is one of the primary reasons why coal and nuclear are strong assets to own, because they provide that base load generation, a lot of generation at one facility that can capitalize on economies of scale. Here you can see how the price of natural gas has driven the market in a slightly different direction, however. The blue line is coal generation, and you can see over the last 15 years or so how the coal generation has lowered. You can also see how the natural gas generation has risen almost in step with the coal reduction. So as coal steps down, natural gas replaces it and steps up, or vice versa. As natural gas steps up, coal steps down and is being replaced by natural gas. You can also see a slight increase in wind power on the black line here on the bottom as subsidies have kicked in and generated more wind power. And you can see that nuclear has been relatively stable, although we have closed about 6 plants in the last 10 years. So nuclear is starting to feel the effects of natural gas as well. And nuclear power generation is going to start to lower even more rapidly. Let's talk a little bit about the competitors in the market. Although the companies that provide competition aren't as significant as the fuel mix that you have in your generation fleet. But the primary competitor to FirstEnergy is definitely AEP. AEP operates in the same region as FirstEnergy and is a much larger company at $87.2 billion in revenue compared to FirstEnergy's $11.2 billion. AEP is also a fully regulated utility. They are in the process of closing the remainder of their merchant generation fleet, which is coal, and they're going to become a fully regulated utility, just like FirstEnergy is about to become as well. On the non-merchant competitive side, it's like I said, it's not as significant because it's more about the fuel mix than it is about the companies. Natural gas is far cheaper and is driving bidding prices down, and that's really the competition. If you own a lot of natural gas plants, you're good. If you own a lot of coal or nuclear, you're struggling right now as a company. As I mentioned, there is a retail book and distribution side of the company, but they don't generate enough revenue to really make up for the losses in generation. So here's what happened. FirstEnergy and FirstEnergy Solutions are different companies. That's because FirstEnergy Solutions was the part of FirstEnergy that handled all of the deregulated or competitive parts of the business, from the distribution to the generation to the retail. FirstEnergy owned other subsidiaries which handled all the regulated parts of the business. It's legally required that those two parts of the business were separated. So they were in different companies underneath the FirstEnergy holding company. FirstEnergy has since separated from FirstEnergy Solutions when FirstEnergy Solutions declared bankruptcy in March of 2018. Furthermore, FirstEnergy, a couple weeks prior to that bankruptcy declaration, FirstEnergy announced that the 3 nuclear facilities would be closing it by the end of 2021 as a result of cost pressures from natural gas, unless they are given some sort of credits for being green energy by the states or by the federal government. FirstEnergy Solutions had several bad contracts and significant bond debt that it could not repay, leading to the bankruptcy filing. However, court approval has been obtained on the 15th of October of this year for the restructuring plan, and FES is expected to emerge as a new company in the first quarter of 2020. As I mentioned, FirstEnergy will no longer have ownership in FES, and as a result of the court proceedings and the settlement, FirstEnergy will provide $1.1 billion in cash and forgive about $2 billion in claims to FirstEnergy Solutions. Let's talk a little bit about FirstEnergy's financial performance, which also highlights why FirstEnergy is separating from FirstEnergy Solutions and going to the competitive market, and the financial impacts of the competitive side of the business on FirstEnergy. So here you can see the earnings per share in 2014 and 2015 were relatively weak. That's because the competitive side of the business was keeping profits down, and it was certainly a weight on the company at the time. Furthermore, you can see that in 2016 and 2017, earnings per share were well into the negatives, and that's a result of the discontinued operations you can see above. So the discontinued operations are a result directly from FirstEnergy lowering the price of their assets. They actually took asset impairments of $9.2 billion in 2016 and over $2 billion in 2017 on the competitive side of the business only. The regulated assets stayed the same. The reason they took these impairments is because the company was trying to sell that part of the business to other companies, and they were unable to do so. So being unable to sell the business, they impaired the assets all the way to $0, which means that they weren't worth anything. Then, with the assets worth nothing, FirstEnergy Solutions was in a real hard spot, and that led into the bankruptcy filing at the end of the first quarter of 2018. You can see FirstEnergy has somewhat rebounded to become more cost effective, and they are generating earnings per share now for the shareholders, and their revenues actually look good, and their stock price is up above $40, whereas before it was down in the 20s. So FirstEnergy's shareholders have responded to the exiting of the competitive market and becoming a pure play regulated utility. The shareholders are certainly happy with that. Let's talk a little bit about the core competencies of FirstEnergy Solutions now. So the structure and the process of the company are certainly the most advantageous part of the company. There are many complex laws and regulations that oversee this utility. OSHA, nuclear regulations, environmental regulations specifically to coal plants, but every utility has environmental regulations to follow. It takes decades of maturing processes and procedures to ensure compliance while ensuring operational efficiency of the units, or else they won't be cost competitive. That compliance not only helps to ensure that we're following the rules, but it also saves us money because we don't have the regulatory authorities watching over our shoulder. They have more trust in us that we're doing our business. That open and an efficient process that we have gives us that margin and lets us run our business more efficiently as well. Furthermore, those processes create operational efficiency. They reduce human performance errors. They reduce injuries. And so the sites can benefit from better performance as well. It's very difficult to replicate this culture because even benchmarking, at Beaver Valley, we benchmark other nuclear facilities. We go there, they open up everything to us, they show us exactly how they do things, they give us their procedures, we come back to Beaver Valley, and it's very difficult to implement their processes because their cultures have taken so long to ingrain in all of their workers that it's very difficult to just take something and bring back. Cultures are a tremendous asset in the electric utility business. Furthermore, assets are expensive to build in the electric generation business. There's a high entry cost, which limits competition from really entering the marketplace. So there aren't a whole lot of new businesses popping up in the utility business, but that market is shifting because as natural gas becomes cheaper, these businesses are building more natural gas plants, which is putting price pressure into the marketplace. Furthermore, the solar and wind subsidies here at the bottom, the solar and wind subsidies are also affecting the market as more solar and wind generation comes online as well. So FirstEnergy must ensure that even though that process and the culture is their core competency, that they don't let that obscure their strategic vision. They must continue to find technology and opportunity while they exploit operational efficiency of the units. So the generation assets run well and provide a lot of values to the company. However, the lack of diversity in the assets is a significant weakness of the company right now. There's an opportunity for FirstEnergy Solutions to emerge with a new brand. They will be a new company with a new name, with a new website, with a new infrastructure that they've been able to kind of pick and choose by hand how they want structured. So they should be able to capitalize on that reorganization to become a modern company. And in turn, they must beware of the politics and the price threats that exist in the marketplace right now. Like I said, FirstEnergy will become a new company. They'll shed their FirstEnergy image and rebrand themselves. They can capitalize on more efficient business operations and look to contract key functions of the business to become a leaner organization that perhaps other companies can't do because they haven't had that bankruptcy to be able to leverage. They look to go public in 2022, which means they must find opportunities to add value to the organization, maybe through acquisitions or capitalize on political opportunities such as state credits in Pennsylvania. They were successful in getting state credits from Ohio already. They must beware of change management. Change fatigue can set into the workforce and could be detrimental for sure. Finally, operational effectiveness is going to be the key to their continued performance. Thank you very much for watching my presentation. Good luck to all of you in the future.